Okay, good morning, everybody. We'll go ahead and get started today. Sorry, I'm a little late getting going. So we're going to start talking about chapter 11. And on Wednesday last week, we got into so we did some example problems and exercises from the back of the chapter, chapter 10. So if you have any comments or issues with respect to the chapter 10 homework quiz and bonus, let me know, and we'll try to resolve those if there are questions about them or whatever. I'm more than glad to to go over those. Chapter 11, and I thought we may get to chapter 11 last time, but we sort of ran out of time. But that's okay, because it was a good stopping point. This really sort of brings us into managerial accounting, which is really the heart of what this course is. The second branch of accounting is from financial accounting is managerial. So, which is why managerial comes before. I'm sorry, financial comes before managerial. It sort of builds on it, but it focuses on some very specific things within the accounting realm itself. And before we get going, one of the things that I had made a note of that I wanted to show last time was this: a couple of things. Number one was the issue of profit margin, and I pulled up some information, and there are plenty of resources out there. I know if you're looking online or on the video, it's probably hard to see this, I know, but I can send you the link if you like. But this kind of gives you an idea of what some of the what the difference between gross margin and net profit margin. So when we talked about ratio analysis in chapter 10, we talked about something called a profit margin ratio, which is a percentage, but it's the bottom line net income. I know this is kind of hard to see. It's really small, but there are a lot of different sites that are out there, and I try to pull in extra resources when necessary. But that is quite different from gross margin, and gross profit is expressed as a dollar figure. Gross margin is expressed as a percentage. Now, those are really fuzzy. I'm standing right here, and they're kind of fuzzy, so I know it's hard to see. The numbers aren't really that important, but it's the idea of two things. Number one, the difference between gross and net, and this is a topic that comes up all the time, everywhere in accounting and finance. Gross, net, gross, net. Gross is simply the growth, and gross profit is simply sales minus cost of goods sold equals gross profit. Gross profit is expressed as a dollar figure. Gross margin is expressed as a percentage. The percentage of gross profit in relation to revenue. It's simply gross profit divided by revenue. And so when managers in the corporate world talk about margins, they're almost always talking about this margin right here. Not so much this. So they're talking about what are our margins. In this case, the margins have gone down a little bit over time. And that would be possibly a cause for concern. So actually they've gone up. I'm used to seeing that the years come this direction, and this slide they go that way. So I kind of watch the columns. So that's kind of the difference there. I wanted to show you that the gross margins are really all over the place for all kinds of industries, as are returns on equity. And I pull up this slide here. It's got different industries that have number one, the industry itself, so broadcasting, chemicals, coal, whatever. And it's got the number of firms in the industry. It's got an unadjusted ROE, and it's adjusted for any kind of research and development expense. Now, we didn't really cover that in chapter 10, but what we did cover was the idea that all these ratios can be manipulated, sliced and diced. Some of the ROE figures that on this particular site did not include removing preferred dividends from the numerator. And most do not. And so, most of the examples, when I see ROE, I usually don't think of taking out preferred dividends. I mean, the logic is simple. It's the idea that they're non-discretionary payments out of net income. But nonetheless, look at they're all over the place. And sometimes they're negative, meaning that it's either net income or negative equity, probably negative net income. So there are some industries that have negative. The industry itself has a negative return on equity. The biotech industry, a negative return on equity. This could be negative equity, actually, because there's so much debt as these companies are getting going. And I'm sure debt outweighs the owner's equity, the shareholder's equity in these cases. But there are all kinds of different, they vary all over the place, from as high as some 30%, as low as some single digits. Advertising, extremely low ROE. And the thing about it is, I think we should be careful about making an interpretation across industries, because we have to look more inside the industry. I wanted to show this just to show you the diversity ROEs that they're just all over the place. And I know it's hard to see and whatnot. And if anyone wants the link, I can send the link. But if you take advertising, for example, there probably is not a lot of reason to reinvest earnings back into assets. Probably whatever they make, they might as well just distribute to owners, because what is advertising? It's a service business. There's not a lot of equipment. There are no vehicles. There are probably not big premises, plant equipment, big facilities and whatnot. So it would make sense to have a fairly low ROE, because why would you want to have a big ROE? You might as well just dividend it out to owners or pay employees. And so that we see this a lot in service industries, extremely low ROEs, but that's the nature of that particular business. Okay, so anyway, any questions about that? I did want to kind of get into that a little bit, just to sort of show what is going on with ROE as a general concept, and just to give you a bit of the idea of the diversity. And even though I know that there are some economists who believe that, say, a 12% ROE is the minimum acceptable ROE to have, well, that's who knows? That's hard to say, and it varies. Real quickly on managerial accounting, the next set of problems is going to be due this Sunday, and hopefully we can get through some of this content here. It's not a particularly long chapter. I don't think you're going to find it to be. I don't think you'll find it to be a particularly complex chapter. So I think you'll get a lot out of this. At least that's my hope. So in this chapter, it's our introduction really to managerial accounting and what it is. And so it's all managerial from here on out. And we have 4 learning objectives in this chapter. Number 1, we're going to talk about what sort of the definition of managerial is, describe it, sort of talk about how it works, what the uses of it are within companies. We'll talk about manufacturing in particular. I mentioned before in class, and I want to circle back to this, is that one of the things that people have noticed, and it's a good observation, is the idea that managerial accounting for many years in managerial accounting texts have tended to focus a lot on manufacturing, and it is not lost on us in the accounting faculty that manufacturing, while still growing in the economy, is not growing as quickly as other parts of the economy like technology, healthcare, services, consulting, entertainment, none of which really manufacture anything at all. So, and the rationale for that is the idea that if you can know about manufacturing, some of the same concepts can apply, because they can simply be applied to service industries. And we'll give some examples of how that is the case. The third learning objectives, we'll talk about a figure we haven't talked about before, and that is cost of goods manufactured. So up to this point, if you took 2110 or its equivalent somewhere else, you learned about cost of goods sold, and we just sort of took that as a given. We just sort of gave you, okay, this is cost of goods sold. But if it's a manufacturer that makes things, physical things usually, then there is an intermediate step to get to cost of goods sold. That's cost of goods manufactured. And these are goods not yet sold, but it captures the cost of those goods as they're produced. And this would be really the cost of final goods. And I'm going to talk a lot about this idea of what we call inventoriable costs. And then we'll talk about some trends in managerial accounting itself. So let's kind of start with talking about some basics here. And that is, what is managerial accounting about? Well, and one way to sort of get an understanding of managerial is to really compare it against its twin, which is sort of the other branch of accounting, that's financial accounting. And some of these differences we've talked about, some of the similarities we probably have not yet talked about. Well, we deal with economic events, and so that is the idea that even though accounting, and I've said this before, and we'll probably say it again, it's not really about the numbers, it's not really about math. It seems like it is. I know we've had students over the years who said, I'm not good at math, I'm really worried about this. It's really not about the math, it's more about logic and organization, keeping things straight, that sort of thing. And it really is. I'm downplaying it more than, and I'm not trying to ignore people's conservative numbers to the extent that people have them, but I'm really emphasizing the fact that it's not really about math. And they both require that these quantified numbers are communicated. The interested parties are who really differ here, and this is really an interesting slide. Again, this slide package are just as drawn from your book. There's also the package itself, and sometimes I make some adaptations to it. But this is a good one. This is illustration 11.1 from your text. And it has on this left column the financial accounting attributes, and managerial accounting. And so let's look at some of the key differences here, because I think the differences really sort of define what managerial accounting is. Number one, financial deals with reporting to external users. When we've talked a lot about in chapter 10, shareholders, regulators, investors, lenders, that kind of thing, would-be investors, including companies that buy large positions in public companies, that is companies whose stocks trade publicly, pension funds, mutual funds, etc. Managerial accounting, though, reports to internal users, officers and managers. That's why it's called managerial. It's because it's really for management use, and that's really what's going on. There is a definite schedule within financial accounting. Remember, financial accounting and all the reporting of public companies, and remember, we take the orientation, we're dealing with public companies, that is, companies who are registered with the government, who issue shares on stock exchanges, New York Stock Exchange, NASDAQ, or whatever. At a minimum, they've got to report quarterly, and then they've all got to report annually. So quarterly and annually, and that they're produced in accordance with what we call generally accepted accounting principles, or GAAP. And those principles are so that people can look at them and know where the numbers came from. And obviously, for those of you who may be accounting majors in the future, you'll know that that's really the beginning of the story, that you sometimes have to delve into the notes to find out how they calculated cost of goods sold, what was the inventory benefit, yada yada. But it's there, and it's available, and it's available to anybody who wants to look at it. And a lot of this information is more available now to the average person than what it was even 50 years ago. I mean, the internet has really enabled people who really want to look at statements and who are able to look into them to understand what's going on. Managerial, on the other hand, these are internal reports, and they'll be produced as frequently as needed. Monthly is probably a fairly frequent time reporting. These are things like cost reports, these are production runs, these are personnel costs, these are things like quality control reports, wastage, damage reports, safety reports. I mean, the number of reports is practically infinite, and the reporting period is very much at the discretion of management. As I've talked about before, and I think I mentioned in this class, Warren Buffett, the great investor who owns a big piece of Geico insurance, wants a report every day as he gets home from work. He wants somebody to report the dollar amount of premiums that were sold that day. He just wants that on a daily basis, on every business day. And so, and that's not that unusual. In fact, as technology allows accounts to extract information from various sales units and cost units, so this information can be produced, uploaded to what we call a dashboard format, which is a very simplified way of putting it all together. Sometimes graphs and charts, and some managers like to see pictures more than anything else, and they can see things going in more or less real time. And by real time, I mean on as current a basis as needed. And these are special purpose oftentimes for specific decisions, as opposed to the more general reporting, which is standardized based upon GAAP and the Financial Accounting Standards Board. It sets the tone for what's reported. In financial accounting, it pertains to the business as a whole. We say they're highly aggregated. When we talk about big companies, particularly companies with lots of divisions, lots of international operations, lots of subsidiaries that do different things, companies will very often report on what we call a consolidated basis. And what that is really an effort to lump everything together. So they'll have like one line item that says revenue, even though it may be from 7 different kinds of subsidiaries doing wildly different things, from making soda to owning movie studios to theme parks to making sweaters. I mean, it's, you know, these are conglomerates in many cases, but it's also for the purpose of trying to confuse your competitors so that they can't pull apart the information on how profitable each division might be. Sometimes they break it out, sometimes they do, sometimes they don't, and they do what they have to do, and it's limited. And again, it's governed by GAAP. In managerial accounting, it's often extremely detailed. It could be any individual department, it could be any individual shift, any individual work team within the shift that might be the reporting as to how much was produced, how much was wasted, how much in cost was incurred, how many labor hours were involved. It can be extremely detailed, and it's not based upon any sort of GAAP standards. Now, I know that financial accounting reports have to be audited by a CPA. And there is no auditing. These are unaudited information because it's just for management's use. There is a certification for certified managerial accountants, and they take an exam. It's called the CMA exam. A lot of CPAs who work inside companies are also CMAs, and it's not that it's standardized reporting. It's more just some of the best practices as to how you report cost in particular. And cost is a big theme that comes up again and again and again. Okay, so these are some of the highlights, some of the differences here. And one final thing I'll say about this is that, it'll probably come up just in the course of our doing problems and exercises in class, is that very often this information is not shared with outsiders. In fact, sometimes they're not even shared with employees who even are involved in the activity itself. It might not even be shared with people in management. I know the first company that I worked for, we would get pretty detailed financial reports, and there would be, and because I was a fairly low person on the total pool starting out, there would be whole fields would be blacked out. There'd just be exits across the field because I was not authorized to get that information. And they thought it was too strategic to allow a low-level manager to get it. And as I moved up, those X's were removed, and they were sort of revealing, opening up what was going on. And so this information is confidential. You don't want it out of the street. A lot of companies go to great lengths to not print this stuff in some cases. And we can do that now, obviously, since paper is becoming a thing of the past. It comes to reporting. But when it was printed, we were always very careful. Sometimes we go to meetings and they would hand out information and then they would collect it back from us. They didn't want it out on the street. They didn't want somebody to lose it and blow away and have competitors pick it up. And I worked in a financial district where our competitors were all sort of right there. So they would love to know some of that information. So when we talk about management, I do want to talk a bit about management. And I know that this next few minutes is going to sort of verge on business administration, which is a different department, a different sort of way that we view business. But I think it's important for us to figure out and understand lines of reporting and what it all means within a company and within the company setting. So when we talk about management, and there's a traditional set of concepts or roles that managers play: planning, directing, controlling. When I first started business school, there was planning, organizing, directing, and controlling. Organizing seems to have gone on the wayside. But planning is more of a long-term thing where companies are looking at strategic management, deciding where the company is going, why are we here, what can we do to maximize profit. Remember, business firms, and we take the point of view of a publicly traded for-profit entity. They've really got two main objectives: to maximize profit and to maximize the value of the firm. And so a lot of these questions are, how do we do that? What can help us to maximize profit? Directing, that is more of a supervisory issue, finding out what needs to happen. How do we organize things? This is why organizing seems to have been dumped into this. And then controlling, which I always found interesting. I think the lower level supervisors, managers seem to spend most of their time on this thing. I know when I was in management, just starting out, most of my day was putting out fires, keeping things on track, making adjustments, tweaking things, trying to control costs, and controlling is a big issue. As people get higher in management, there are really two main areas that they focus on. Number one, it's budget. And budget, we're going to talk a lot about in this class. Budget is simply this idea of planning our roadmap, quantifying it, and then assessing how we're doing. So budget is one task as one gets higher in management. And then personnel, people decisions. Those are big issues. Okay. This is something I highlighted here. The green type is obviously my own, and that's sustainability / ESG. So ESG stands for environmental, social, and governance. And this is a very much a trend in regulatory circles where regulators are requiring companies to be more attuned to sustainability, particularly environmental sustainability. And a lot of companies are moving toward a case in which they're emitting fewer greenhouse gases to the extent that they can, or they're reducing waste. And there are some companies that are doing more of their energy inputs by solar, and so that's it. But that's not the only part of the picture. I know a lot of people like to focus on environmental, particularly the critics of the whole environmental effort within companies. And there are critics out there. But the social refers to how are we, uh, how are companies being good citizens in the markets in which they operate? And are they doing things that adhere to the law, that benefit society, or are they doing things that do not benefit society? So that's an important issue there. And then finally, governance. And governance refers to internal governance, not to government, but to internal governance, starting with the board of directors, working its way down. And that is how good, how well is management controlling the situation? How well are they doing these things? And by that I mean, are they emphasizing internal control? Do they have accountability for all people in management? And by the way, managerial accounting, one of the things we're going to get into, particularly as we get into reporting, is this idea of trying to use the tools of managerial accounting to assess the performance of managers. I think a lot of us, if we have just started out in the business world, we see managers as being sort of, I don't know, sometimes people who don't do very much, but just sort of sit around in their office and drink coffee and whatnot. And if that's the case, that's probably not a very good manager. But managers are to be held accountable, and just like everybody in the organization. But there are a different set of standards. They're usually quantifiable, and the higher one gets in management, it really becomes about the numbers. It really does. It's not about the math, it's about the numbers, because the numbers are the way we quantify things. And so governance refers to how well the company has it under control. Are the board members active? Do they know what they're doing? Is the board diverse? Are we representing the demographic mix, the diverse mix that mirrors our employees, mirrors the markets in which we're doing business? I know when I was in grad school, we had a number of case studies about boards that were made up of exclusively white males. Well, that is not very diverse, and that does not reflect the makeup of employees, customers, shareholders, or the markets in which they do business. And so this issue is important, and it's the idea of being responsive to the needs of society generally. So ESG is a big issue. We talk a lot more about it in financial accounting, and this role, by the way, of accountants is being expanded to include this more and more, and particularly in the European context where they have a different set of regulators. But I was on listening to a podcast not too long ago, a month or so ago, where accountants were being tasked by European regulators to create a greenhouse emissions report. And they had no idea how to do it because they said, we're not environmental scientists, we don't really know how to do it, but regulators wanted it. So this is something new, and accountants are having to change their focus to do things they didn't have to do before. All right, I want to talk about the organizational structure, and I know this seems like we're not really getting into the accounting very much, and believe me, this definitely does relate to accounting, and it relates very specific to managerial accounting, because what we're doing here is, first of all, this is a very generic, I always do that, very generic organizational structure, if I can get it to be, there we go. I try to make it as big as I could without so this is a very generic structure. It's sort of hierarchical. There are different structures today. By the way, if you were to Google company organizational structure, you find millions of hits and all kinds of different structures and diagrams that people report to two different people. One, an administrative line of reporting, the other, more functional line of reporting. There's no one size fits all. This is pretty traditional. I don't even know if I were doing this, I don't even know that I would put stockholders up there. Yes, they're the owners, but in terms of management, stockholders really have very little to say, usually, unless they have enough shares, percentage-wise, that they get on the board of directors, in which case they do have something to say. The board of directors is the topmost governing body of a company. One of the things in governance, and there's been just a tremendous amount of work done in academic accounting about the effectiveness or the lack thereof of directors, because there are some directors, and there's a mix of internal and external. That is, internal officers who sit on the board, plus a lot of external, maybe a 2-to-1 balance, external, internal. But the question is, how effective are these external directors? A lot of them are prominent people, ex-business people, former politicians, prominent people. But how much do they know about running a steel plant? How much do they know about it? Or making cigarettes? I mean, it's been a question as to how significant, what role they play to be paid a pretty good salary to go to a meeting once a month or once a quarter, whatever the case might be. But the board of directors is the key governing body. And then the CEO, which by the way has only been around about 50 years, I guess, as a thing. We usually refer to a president as being the top person. Sometimes the CEO is the president. What is more common is to have a chairman and CEO. The chairman of what? Chairman of the board of directors. And then below that might be a president. The president might deal more with day-to-day operations. The CEO may be more relations with the board, more strategic planning, that sort of thing. But the term CEO now has been codified, as well as that of CFO, Chief Financial Officer, by the 2002 Sarbanes-Oxley Act, which requires those two people specifically of public companies to every quarter and every year say we individually warrant that these statements are accurate. Okay. And then we get into the functional areas, and this guy, and I'd say guy, I think it could be anybody, but historically there were three key operating areas within what we call functional areas: finance, operations, and marketing. I should say these three: marketing, finance, and operations. Today, I think HR has sort of moved into a fourth functional area, just because there's so much that needs to be. That's a very specialized area. There are entire specialized degrees, special certifications. Society of Human Resource Managers has a certification for these. So these are the functional areas, the day-to-day running of the company. Operations deals with things like production, serving customers and whatnot. Finance, we'll talk about in a minute. Marketing deals with promotion, pricing, advertising, and all the things that go on under HR. Legal and IT, these are areas. Again, these structural organizations may differ, across companies, but it's pretty common to have both CEO and CFO, and these four functional areas here. I do want to talk about this since this is an accounting course. So within accounting departments, you've got a treasurer usually, and we're talking about big companies. Treasurer's job is to manage the cash of the business, to make sure that the company has cash. We talked about before that there are some expenses that are absolutely essential to have cash on hand. One of them, of course, being payroll. And so the main job of the treasurer is to make sure the cash is sufficient to meet operating needs, and when it isn't, to go find sources of cash. Internal auditing, what's interesting about this is that in most organizations today, internal auditing is sort of out here and usually reports directly to the board of directors, or there may be an intermediate step called an audit committee. There could be an audit committee that they don't report to, but they're involved. The audit committee oversees day-to-day operations. Audit committee is typically made up of senior managers and outside people as well. But auditing usually stands apart. And in fact, there's an effort right now in companies to put auditing sort of out and independent. Auditing is mostly independent of the day-to-day operations of the company. To be very, I know when I was in the corporate world, we sort of viewed internal auditors as sort of being the cops, right? And that's kind of what they are. And I know that that's a very simplified way of looking at it. But they're the watchdogs for management, and they're the ones who conduct internal audits. They check up on people, make sure that everyone's complying with the law, that they're complying with policy, and that controls are in place so that we protect things like valuable inventory, cash, those kind of things. So auditing very often does not report to a line manager, but rather reports to the board of directors directly. And then the controller is the chief accounting officer. Under that person, and that person's department, accounts payable, accounts receivable, sometimes tax would be in there, sometimes purchasing would be in there. But the key thing here that I wanted to really talk about was this idea of auditing and where auditing sort of fits into the case. Usually only having accountability to the board itself. And then one final thing here concerns line versus staff, and this is a good segue to where we're going. And because there is a reason why I'm spending time really talking about these, and that is a lot of it has to do with the way that we view and all employees within an organization. You can take every single employee all the way to the CEO and say, and categorize those workers as either line or staff. Line employees usually are involved in the operational aspects of the job. They're involved in either producing the product or service or working directly with customers. They've got interface with the actual demand side of the market, or they are producing the product that goes to satisfy the demand side of the market. Those are line employees. They would include people in management as well as people who are very much down the line, working on the shop floor or factory floor or whatever. And this has nothing to do with exempt versus non-exempt as to whether they fill out a time card or don't fill out a time card. This is just the way these are organized by function. And they differ from staff employees who do not produce the product. They're support staff. They're support staff. And we're talking about a range of people in this particular area. HR comes to mind as being support staff. They don't make the product. They don't deal with customers. They don't promote the product. They're not in charge of the sales and revenue issues at all. So that's what they deal with. Also, IT would be staff employees, legal staff employees, and the accounting staff itself. And so this becomes an issue because pretty much the work of these folks here is put into the cost of the product. And we're going to get into that very shortly here. This idea of what the work that these guys do goes into the actual product cost itself, whereas the work of these folks is simply reported as an expense, and we do not dump it into product cost. This is going to be important. And so for right now, this might be kind of irrelevant or seemingly kind of abstract, but I do want to make it meaningful by bringing it back to product cost. Okay. So any questions about the structure itself or the difference between managerial and financial at this point? Anyone have a Zoom call? If you can put something in the chat box, I'll probably see it. Doesn't look like that, but I can hear you if you want to speak up, and you don't have to, but if you do, don't feel bashful about doing that. Okay. All right, let's take a look real quick out of your book. We're often have these little cutouts here. Quick quiz. They've got the answers for you, so it's pretty simple. Managerial accountants have a single role. False. Financial accounting reports are general. Yes. And they're intended for external use. Yes, that's true. Managerial accounting reports are special purpose, issued frequently. True. Managers' activities and responsibilities can be classified in three broad functions. Cost accounting, budgeting, internal control. No, it's planning, directing, and controlling. So that's false. And then managerial accounting reports must comply with GAAP. And that is not true. And we need to be clear they do not comply with GAAP. And by the way, there are a lot of areas that do not comply with GAAP in accounting. Tax accounting is not GAAP compliant. It's not intended to be GAAP compliant. So everything dealing with tax is not there as well. We're not going to get into too much of tax in this course, but GAAP is for a specific purpose. Okay. All right, let's talk about cost, and that's really sort of a key factor here when we talk about cost. And sometimes, and I think in our syllabus itself, in the language that we use in the syllabus talks about cost or managerial accounting. And managerial accounting is sort of sometimes called cost accounting, just because there's so much focus on internal costs. One thing that we should be clear about is this, and I think it's an important thing to know. And this is a very simplified model here, is that you've got inputs, and the inputs are usually evaluated in terms of numbers, whether it's pounds of materials or units of materials, number of labor hours, whatever the case might be. And inputs create costs, which are expressed as a dollar figure. Okay, so inputs create costs. Outputs, on the other hand, which are being created here, which are expressed as number of units sold, or number of customers served, or whatever it is, and outputs create revenues, which are a dollar figure. So we're going to be looking throughout this, and this is obviously a very simplified model of the situation, but we're going to enumerate inputs that create costs. We're going to enumerate the outputs that create revenues, and obviously the key thing to know is that revenues minus costs equals profit, and profit has got other names. Income, earnings, a lot of terms in accounting have multiple terms to describe it, but it's the same thing. It's the difference between revenues minus costs. If costs exceed revenues, we have a negative profit. And that happens sometimes. It is sometimes the case that does happen. So there's a big focus on these differentiating factors. This is not exactly earth-shattering model. It's not Nobel Prize winning stuff, but it is something I think lays out the case of why cost is such an important aspect of managerial accounting. So when we talk about managerial accounting, management is oftentimes faced with these sorts of what ifs. And one of the things that accountants do particularly inside companies where they're used. And by the way, we talk about managerial accountants. Somebody in my other 2120 class asked, well, do they have multiple clients? And usually that's not the case. Usually they're employees of an organization. Unlike a public accountant who might work for an accounting firm, they might have multiple clients. Usually managerial accountants are employees of a single company. Okay, there are firms that will help and assist and do some of the managerial accounting for companies, and they will not be employees, but that's a separate service. Most are involved inside the company itself. And so very often accountants are asked by management to do what ifs. And that is, what happens if we make a product, if we make a new product, what's going to happen with cost? What's it going to cost us? What we can expect to sell, given a range of alternatives. And of course, this is where spreadsheets come in very handy, because you can make all kinds. Once you lay out the basic relationships, you can play with the numbers and find out what you need to achieve, and then work backwards from that. And very often companies do work backwards. What do we think we can sell in the market? And then what's it going to cost us to do that? And do we want to do that? Does that make sense strategically? Or things like, if we decrease, or I would say, if we increase, how will costs change? We're going to talk a lot about these different scenarios as we get going throughout the course. What impact will automation or any kind of technology have? And what can we do to control costs? These are all questions that are obviously fixated on cost. Cost being an internal matter. And that's really the thing that we should really talk about, is the idea that inputs and costs are internal matters, and costs tend to be mostly confidential. We don't want to share those, particularly at very micro levels. Outputs and revenues are obviously bring in the other side of the market. So that's the thing to look at. So various what ifs and doing scenarios. And throughout the rest of the course, we have the way the modules are sort of organized are how do we account for costs differently, particularly when we get to overhead. And we'll get to that in just a second here. Or what if we have a special order? What's that going to do? Can we do it? Should we do it? Those are what ifs that managerial accountants are oftentimes faced with. Okay. So scenario analysis and what ifs are very important. Okay. All right. Let's talk about these manufacturing costs. These are the big three. You're going to want to get familiar with these. These are general categories. These are not line item costs. These are categories. Direct materials, direct labor, and manufacturing overhead. You're going to get familiar with those. We're going to be working with those probably in some fashion every module as we get going throughout the rest of the course. These are not individual items, but they are categories of items. Direct materials and direct labor together are what we would call direct costs. Now, these are all product costs. These are costs which are allow us to determine what does it cost us to make these outputs. Inputs which create costs go into creating outputs. And as inputs go down the process, down, they're picking up costs to create the output. And of those costs are these three categories: direct materials, direct labor, which we call direct costs. They're fairly easy, oftentimes, to account for, and they're measurable and they're observable. We can usually track them very easy, especially labor. Labor is actually pretty easy to account for, because obviously the direct labor that we're talking about here, which is usually involved in producing the product, usually the labor hours are very definitely accounted for. The government requires that there are exempt and non-exempt employees. Non-exempt employees are not exempt from filing a time card. Even though it may not be a physical time card, they report a different way. They have to account for their hours. And so that way, overtime laws are being adhered to. And so this is pretty easy to account for. On the other hand, this is what we call an indirect cost. These are direct costs. This is an indirect category costs, manufacturing overhead. And this becomes quite a challenge. And we're going to be dealing quite a lot in this course about what do we do about overhead. And overhead is a term that's very generic and maybe is not even that descriptive of what it is. I mean, I think we think of overhead as being literally overhead. That is the cost of the facilities in which we're doing business in, the lighting and the heating and all that kind of thing. It would include that because they're necessary to making the product. They're inputs whose costs are necessary to be incurred to make the product itself. But the thing is, though, these are much more indirect And how we account for those and how we dump them into product cost, if we can, is much more challenging. We're going to be talking about that as we get going. So let's talk first about direct materials, okay? And when we talk about direct materials, we're talking about things which come to us that we would describe as raw materials. Now, raw materials, if you think, I think when most of us think about raw materials, we're thinking about very raw materials, things that just came out of the ground like coal and iron ore and or timber or things like that. But they may not be that raw at all. They may be processed and they may be raw to the particular user in question. So, for instance, I had a couple of uncles who worked in an aluminum plant, an Alcoa plant. They produced big, huge rolls of aluminum, and then they would sell to their big customers that would make mostly beer cans with them. Well, they're obviously not aluminum that just came out of the ground. It's a refined product, but to that company that makes cans, that would be a raw material. So raw materials are basically just the basic physical quantities of things, physical, that go into making the product. And they can be physically and directly associated with the cost itself. In other words, we absorb those costs. This process of moving inputs and bringing inputs into the production process to create outputs is what we call absorption. And the method that we capture the cost is called absorption and costing. And that term itself is not used very much in this textbook, but it is what's going on. And it's a thing in accounting that it's long been a challenge to determine what does it cost to make a product. And it's a question that we ask a lot of ourselves. All right, when we talk about materials, since we're talking about materials here, and by the way, the way these slides are sort of organized is we're talking about materials, direct, indirect, labor, direct, indirect, and then we get into overhead. So we're still talking about materials, but these are indirect materials, okay? These are things that have these characteristics. You know, they're not physically part of the product itself. And I put down here some examples of things which are not physically part of the product. Things like cleaning agents, like cleansers. Products come out and they're dirty, they're going to be clean, but they become part of the product cost because it's necessary to get that product. You can't deliver dirty products that are greasy and nasty as they come out of the production process. They've got to be used for things like temperature. You've got to heat some products up to make them, or cool them down to make them. And so those do not appear obvious as part of the product cost. You can't look at it and say, well, this product was once heated up to 500 degrees. It's not obvious. Or they are physical, but they're very impractical to trace to the product itself, either because they're too small or they're too abstract and nobody wants to really account for them. And that would include things like lubricants, like the grease that goes into moving parts, nuts and bolts and screws, things like glues and tapes and adhesives, paints and finishes. So think about this. If you've got a manufacturing company that makes, let's just say they make something like toasters, right? The toasters come out, and there's usually a spray paint that will spray paint those. Well, some of that paint is evaporating. And so how do you account for every molecule of paint? Or maybe I'm showing my ignorance of how you would measure paint. I don't know, but you're going to lose some paint in the process. And so can you track every bit of paint to every individual toaster that's made? I think it'd be difficult, right? Or they're little essential part. They're essential for the product, but it's difficult to attach to the product themselves. There are efforts to make these indirect materials direct by trying to account for them as best as possible. And there's a famous story that goes back really to the 1870s, I believe, where John D. Rockefeller, who founded Standard Oil, experimented with different numbers of rivets in oil barrels to see how many rivets, how many minimum number he could put in so as to save money on oil barrels. This is a guy who was already extremely wealthy, but was trying to save a fortune on that. And it was difficult to do because they made a lot of oil barrels, but they figured out what the minimum number of rivets would be so that they could cost that. A lot of companies don't bother with doing that, but he was rather obsessive in that regard. And so the world's first billionaire, that's probably not surprising that he was obsessed with that. Most companies would rather not spend the time doing that. They would simply take those costs and just dump them into overhead, which is where they're going to go. They're indirect, they're not direct costs. And it's probably better just to sort of lump them together and move on. And by the way, even if you didn't know what the costs were, what are you going to do about them? You have to have these kinds of things anyway. So they're considered, if they're not essential, you probably wouldn't use them in the first place. So that's the materials piece. Let's talk about labor, both direct and indirect. Direct labor, and again, there's a manufacturing focus within this discussion. It's factory employees or any employees that either produce a product or serve a customer, and that they're physically directly associated. In this case, since we are talking about a manufacturing metaphor, that we're talking about converting these physical raw materials into finished goods. That is what direct labor does, all the way through the production process. Indirect labor, they're involved in the production process, but you can't tie them to the output of a single production unit. In fact, the unit may be shut down for whatever reason. And it very often happens in manufacturing where there's a bottleneck somewhere, where there's a machine that breaks down and there's a part that's needed, and you got to go get the part. And it takes a while. And I know when I was, my first job in banking, I did a lot with, I was in a manufacturing part of the country, the upper Midwest. A lot of times these manufacturers, auto plants would shut a shift down because they needed a part. And it's not a part you can run to, Home Depot or Grainger to get. Somebody's got to make it. So a lot of the companies that I dealt with were companies that made individual parts for manufacturing operations. They would have very, very quick orders to do that. But these guys would still be, when I say guys, I'm simply using it as a generic term, would still be employed regardless of the number of output of units being produced. That they're involved in the production process, but only as support, as they're not making the product itself. And some examples up here: security guards to guard the plant, including in the hours when it's not operating. So if it's not operating, then they clearly can't tie their labor to production. If they only work 2 shifts and they have security guards or a 3rd shift that's non-existent. Maintenance personnel, in manufacturing, we talk about maintenance, we're not talking about necessarily janitorial people, but we're talking about people who maintain equipment, fix things, repair things, upgrade things, put new parts in, replace things that are necessary. That's what those folks do. Safety inspectors, and then so-called casual labor that sometimes people are brought in on a part-time basis to do things, like move pallets around or maybe do special things like, paint some interior items or do things. These are people involved in the area of production that don't make the product itself, but yet we put them into that production process because their work is needed. Okay, so that's the labor piece. Now let's talk about overhead, and this is where some of the trouble begins. And I say trouble only because it's a little bit more involved. And remember, when we talk about overhead, we're talking about indirect costs. These are indirect costs. We can't trace direct materials or direct labor to the cost. So we have indirect materials, indirect labor, and a lot of other things which are in addition to those. Okay, these are manufacturing related, except these 2 direct items that we talked about earlier, which is why we call these indirect. And by the way, it's not just indirect materials, indirect labor. It's a whole bunch of other things. And so we're going to talk about those in a minute, including things like depreciation on equipment, which is a very difficult thing to tie to a product itself. So we'll get to those. All right, so questions before we get into the different types of costs for the organization as a whole. And there's a reason why I got into this discussion about line employees and staff employees. It really refers to their functional role within an organization and how we account for the cost that those areas play, both the people as well as the facilities involved. And so we have in general 2 different kinds of costs within organizations. We have product costs and we have period costs. Product costs, we say, are absorbed into the product cost itself. In other words, we say these costs are inventoriable, or we capitalize those costs. The term capitalized simply means that we put them into an inventory account or a series of accounts as the goods moves from raw materials all the way down to some finished good. We say these costs are inventoriable. And I know that sometimes spell check doesn't like that word, inventoriable, but nonetheless, it's a term of art that we use in the accounting area. So what goes into it? Well, the big 3, okay, direct materials, direct labor, and manufacturing overhead. But how they're differentiated from period costs, which we'll get to in a second, these are costs that are integral to making the product itself. So as a result, their costs are not expensed until they're sold, and then they're released in terms of cost of goods sold. So it is very possible. So we think about labor as being a cost of doing business or an expense, right? Cost and expense sort of go together as being the same item. But it could be that we don't even recognize the cost of labor until maybe 6 months down the road when those goods are sold, because that labor is being recorded as part of the cost of the good. In other words, it's put into inventory. We don't recognize payroll expense every 2 weeks for labor that is involved in making products for final sale, to the extent that goods can be inventoried. Instead, those costs are dumped into inventory, and as the inventory is sold, then we recognize cost of goods sold. So a lot of costs are not recognized as they're incurred. And that's part of what the accrual accounting process is doing, is we recognize them when they're incurred, but we don't release them as a final expense on the income statement until the goods are sold. In other words, they're capitalized. This is something that is I think, a concept that's less familiar to people than a lot of other cost concepts that they're dumped into it. By the way, and we do examples throughout accounting where, for instance, we have a long-term construction project. You're a company that makes submarines or aircraft carriers or you build casinos, or you build football stadiums, big, long projects where those costs are being incurred over long periods of time, and they're all sort of being dumped into project cost. Okay. They're not released until the good is actually delivered to the customer. So those are product costs absorbed into product. Then we have period costs, which is everything else. Okay. Everything else is a product cost. By the way, so line employees, their labor and the labor of their entire unit, which they operate, are dumped into product costs. Staff employees, all their costs are dumped into period costs. These are, and by period, we mean the accounting period in which we're reporting those, and we report those as expenses as incurred. As incurred. We don't put them into product costs because they do not belong in as a product. They're not, they're staff employees, they're not involved in producing the products. They're not manufacturing costs. Includes selling and administrative expenses. So what it looks like in a income statement is you got sales, cost of goods sold, and gross profit. Directly below that, you'll have selling and administrative expenses, which is, and sometimes that'll be broken into several line items. And sometimes selling expenses will be its own separate line item. And administrative expenses include all kinds of things: salaries of staff employees, salaries of the top management, things like rent on office buildings, not the production areas, but the office buildings or support areas, lease expense on computers that are used by all the employees within the office areas, depreciation, insurance, property taxes, the list goes on and on. The costs that go into administrative expenses, ones that are not, where we're not able to tie them to the product cost itself. Selling expenses are sort of a special cost, and there are a couple of things that we should talk about when we talk about selling expenses. So selling expenses are considered period costs, and I think a lot of people would not really agree with that, but it is, from an accounting standpoint, how important that. First of all, we're talking about things like promotional costs, right? That we're doing all kinds of marketing and promotion. That could be all kinds of things, displays. It can include things like advertising, right? Which is usually its own category. It can include, and one big one is sales commissions. And I know that there are a lot of people within organizations that have commissioned salespeople who believe this should be part of the product cost. I've known a lot of people in sales who believe that my work is integral. It's fine to make a product until you sell it. It's not even a product worth talking about. So my role is so important, it should be part of the product cost. And it's not, okay? It's not to minimize the role of salespeople, but it's a selling expense, and by the way, it's difficult to tie to a product anyway, because a lot of salespeople work on all kinds of different graduated scales. There are salespeople who might work one desk versus another desk. They have wildly different compensation structures based upon their experience, maybe clients they brought with them, who knows? It's just way too difficult to tie commissions to product cost itself. So it's considered a cost like insurance on a building. I mean, it's that kind of thing, but it's variable. It's definitely variable because selling more generates more commissions. And that's a big one. And then one big one here, which is sort of not always obvious, and that would be the account called freight outs. Freight outs, or sometimes called transportation out. These are shipping costs that are not part of the product cost. Now, this differs from freight in, which usually is paid by the buyer of materials. So if our hypothetical company is buying goods and we're paying the shipping in, that does go into the product cost. And it's an inventoriable cost. So freight in is part of the product cost. Freight out, if we're the shipper, we're sending things out, is a period cost. It's not part of the product itself. And why is that? It's because, first of all, it's not integral to the cost of the product. And it could be the case in which a lot of buyers, usually how freight works is buyers will pay the freight, almost always. It's not always the case. It depends on how the terms are negotiated, but just like you as a consumer, if you buy goods, you're going to typically pay the shipping if it comes to you, right? So it's usually the case that buyers pay it, but where sellers do pay it, we record that as a period cost. And that's an important thing. And we're going to talk a lot about where commissions come in and where freight comes in a bit later as we get going, okay? So any questions so far about these kinds of costs? Again, all costs are either product costs or period costs, okay? And it's going to be interesting that we are going to have to differentiate these costs one from another as we're presented with them, because it makes a difference as to how we account for, ultimately, cost of goods sold. And a lot of what we're going to be doing here the next several class periods is talking about how we get to this cost of goods sold number in an accounting context. And I think that's going to be important for us to know as we get going, okay? All right, so there's an example here. I think this example comes up throughout the text of a snowboard company. And I like this example a lot because it's just got a wide range of different kinds of costs that we're trying to categorize so that we can build, ultimately, an income statement. Remember in financial accounting, what's the order of preparing financial statements, right? Income statement first, statement of retained earnings, then the balance sheet, and then if you do a cash flow statement, that comes at the very end. The cash flow statement is kind of a different kind of deal. But how do we get to that? How do we get to we can't do an income statement until we get to cost of goods sold. And we can't get to cost of goods sold unless we identify what are the costs of those goods that were sold. So that's what we have to know. So in this case, you're given a number of different cost items along the left side. And we have a unit cost, for each. So wood cores, and I don't know, I guess it's $30 per board. We're going to take these as given. Now, we're not always going to be taking these as given. Sometimes we will determine and we'll be asked to calculate this, but we're not there yet. We will be doing some of that. So we're going to say $30 a board for the materials themselves. The labor, we're going to say $40 a board. We don't know what the wage per hour is. It would obviously be an important thing because it would probably be some sort of hourly wage, and how many hours of labor hours it takes to make the board. In this case, it's already been determined for. It's $40 a board. Factory equipment. Okay, now this is part of manufacturing overhead, and that's all the equipment that is used to make these snowboards. We are reporting in this accounting period $25,000 of depreciation. Remember what depreciation is? Depreciation is a cost allocation method of long-lived assets where we don't expense them all at once. Because they've got service value over a period of time, we take that into account. So, but they're involved in making the product, so they are a product cost. Okay, then we got property taxes on the building, advertising, sales commissions, factory maintenance salaries, the salary factory manager, and whatnot. So we'll get to all these, but let's talk about these. So wood, labor to make the boards, and factory equipment, depreciation, which doesn't sound like a product cost at all. This just sounds like some sort of abstract financial cost that we would put on an income statement somewhere. Well, we do, but we put it in an income statement in the context of cost of goods sold because it's the cost of doing business. It's indirect, but it is a cost of doing business. It is a product cost. If we didn't have the equipment, we couldn't make the product. And so we're saying for this accounting period, $25,000 is recognized as depreciation. There's nothing special about the depreciation method used. It could be whatever we choose to use. Straight line is very common. It's, we remember straight line depreciation, not particularly difficult. And why we call all these product costs is they're necessary. They're part of making the product. As we get to the next screen, we got some that are not product costs. Property taxes on the building, that sounds again like some sort of cost of doing business that's just an income statement line item. It is, but it's not an income statement line item that says taxes. This goes into cost of goods sold because it's part of manufacturing overhead. It's on the factory building, not the office building where the company headquarters are, but rather the factory building. Not sales offices, it's on the building itself. Advertising and commissions, these guys here, right? These are period costs. These do not go to the product cost itself. And so as a result, we do not put those in cost of goods sold. We recognize those on the line item on the income statement called selling expenses or selling administrative, or sometimes it's called general and administrative expenses. Those are not tied to the product itself, and so as a result, they're not there. By the way, why are commissions not a part of the sales? I mean, because it could be that the company used to pay people to sell them, and now they sell them directly to customers, maybe on the internet, or to wholesalers, or to retailers directly. Those are not integral to the product itself. And to the extent that companies can cut out salespeople, it might be in their interest to do that. Okay. Maintenance salaries, again, these are indirect costs. People who repair things in manufacturing areas, we put in an overhead. The salary of the factory manager, $70,000 a year, part of overhead. They're involved in the process, but we can't take their output. We can't take their personal labor and divide them on every single unit of output. Shipping, again, is a freight out. It's a period cost. If we pay the shipping, right? And the salary of inspectors, again, manufacturing overhead. So these are all important. So, and again, there's a dollar figure that's already been determined here. And so to sort of round up all of these costs, and by rounding them up, I simply mean getting a grip on all of them. So we're given as we go back here, we've got, all right, we've got wood cores, $30 per unit, labor, $40 per unit. These are per individual unit of output, individual that you could buy, right? So if we produce 10,000 snowboards in a particular accounting period, which we're going to call it a year, 10,000 boards, 30 times 10,000, that is the input cost per unit times the number of units. Again, price times quantity. We get $300,000 of that particular manufacturing or product cost. Labor, 40 times the same amount, 400,000. Depreciation, which we're given as a fixed amount, it's just predetermined. Property taxes given. Factory maintenance salaries given. It's not per unit. These are indirect costs, so they're not per unit costs, right? Factory manager and all that come to $846,000. Divided by 10,000 units, then we get $84.60 per unit as to what it costs to make that good. And this idea of figuring out what does it cost to make a single good is really one of the most important functions that can be done really everywhere in managerial accounting. What does it cost us to do something? To make a toaster, to make a whatever. And by the way, and I talked about this idea that manufacturing is sort of the sort of sector orientation that managerial accounting courses often take. But we can do the same thing with service industries. We can find out what does it cost to do something. If we're a law firm, what does it cost to service a client? How many hours are we putting into that? How much casual labor are we employing, which would be an indirect cost. And so it's the same sort of concept. Whereas if you determine what does it cost you to do business, then you can know what kind of revenue you're going to get, right? Obviously, the formula should be your revenue should exceed costs. Otherwise, what are you doing any of this for, right? So that's the main issue there. So if we talk about these examples here, we can say it costs us $84.60 when we take all these product costs together. What is not included are all the period costs that are involved in this. The CEO's salary is not included in it. Insurance on the main headquarters building, not included in it. Advertising, TV advertising, not included. They're not part of the product itself. So they are not included, okay? All right, so questions about that particular example. I think this example, this company and its snowboards comes up again a bit later throughout the course. It's a pretty good one. I think it's a relatively straightforward example here of how we would take manufacturing costs and put them into product costs. So we got about 5-6 minutes, and so let's see here, because the clock on the wall is a little bit long, so a little bit fast. But here's another example. A bicycle company has these costs: tires, employees of wages of employees who put the tires in the wheels. In other words, manufacturing employees, factory depreciation, advertising, lubricants, which sounds to me like indirect costs, spokes, salary of factory manager, salary of accountant, handlebars, salary of factory maintenance employees, salary product quality inspector, classify all of these. Well, let's do these. We can just do this right now. So, all right, tires, what kind of cost is that? Direct materials, direct labor, or overhead? Or is it a period cost? Direct materials, right? Obviously. Wages of employees who put tires on the wheels. Direct labor, no question about it. Factory building depreciation. Well, it's a product cost, but it's overhead, absolutely. Advertising expenditures, period cost, not part of the product cost at all. Does not go into the cost of goods sold, does not go, and before it gets to there, it does not go into inventory cost. Factory machine lubricants, overhead. Spokes, direct materials, probably direct materials. We probably know how many spokes go on a tire, I would imagine. It's not like individual drops of glue where it's, let's just take all glue and make it overhead. Salary of the factory manager, overhead. Salary of the accountant, period cost. Now, you might be right if the accountant works in that division and is dedicated to that particular thing. That could be right. You could be right, and that's not wrong. In this case, we're just assuming, just all we're given up at this point is it's a period cost. Accountants working in some remote location, internal accountants and whatnot. But there are accountants who are assigned to specific operating or production units, in which case that would be very much like, the indirect labor, like the factory manager, all that. Handlebars, direct materials, salary, factory maintenance employees, overhead, salary, product quality inspector, overhead, right. So you get the idea. If we can trace it to the product itself, it's going to be direct materials, direct labor, or what we call direct costs. The key differentiating factor between direct and indirect both within product costs is whether it's direct and you can trace it, or whether it's indirect because it's hard to trace to that. And again, overhead is characterized by two main defining characteristics. Either it's just generally applied across the production area, like the factory manager. And by the way, factories may not make one thing, they may make 14 different items. So take that factory manager's salary, put it into 14 different products, and every individual product is just too hard to do. So it's indirect, or it's just so small. Here's where we get to the idea of drops of glue or cc's of paint, however you measure paint, I don't know. It's too irrelevant, and so you would dump it into that. So this is again what you all came up with, and that's correct. Okay, these are the items that we're talking about, and this is how we classify them. Okay, so when we come back on Wednesday, what we're going to do is we're going to take these costs and we're going to see where they sort of fit in as they move along the production process. This is a lot of what we're doing in the class, is taking goods as we move along, as a product is moving along from raw materials to some sort of work in process. These are all inventoriable costs, and their costs are captured in inventory. And they're moving along to become a finished good. From a finished good, they're sold, then we recognize the expense at that time, and that's where we're sort of going. So, are there any questions before we wrap this up for today? Okay, well, this is a pretty good stopping point. So when we come back on Wednesday, we'll finish up this discussion of these general concepts, and I think you'll find chapter 11 to be reasonably straightforward. I don't think it's really anything that's too too out there. I think you'll like that. So we come back on Wednesday, we'll finish going through that, and hopefully we'll have some time then to go through some example exercises and problems in the back of the chapter to allow you to be up to speed on that. And then when we come back next week, we'll start to get into chapter 12, which is the last chapter that we'll cover before the first exam, which is a couple weeks from now. Okay? All right, anybody on the Zoom call have any questions for me? Since I've got people here, people there, and so, okay. I'll post the video later today, so it'll be available to all. So if in the meantime, if you have questions for me about anything, feel free to get with me. I'm more than happy to help. So have a great day. See you next time.